am. Okay. Hi, everybody. Welcome to the Kern Fire Safe Council community-wide webinar for October. I'm David Stenstrom. I'm here this evening with Julia Neyman. Tonight, we're going to deal with insurance. And we have an expert tonight is Sally Westlake. She's Associate Insurance Compliance Officer from the Community Relations and Outreach Branch of the California Department of Insurance. And don't ask me to repeat that. Many of us in the wildland urban interface have experienced problems with homeowners insurance in the last couple of years. And Sally is here to discuss in detail what a homeowner's policy looks like and address concerns about being underinsured and what to do if your policy is not renewed. And we will learn about the California FAIR Plan and what the California Department of Insurance is doing about the availability and affordability of insurance and what your rights are as a consumer. In other words, Sally has the facts about homeowners insurance in California, and we're glad to have her here. If you have questions about insurance coverage in the wildland urban interface or your own specific homeowners insurance, please write them down and put them in the chat room. And all of your questions will be answered following Sally's presentation. The Kern Fire Safe Council is a community organization, and our only endeavor is to educate Kern County residents on how to prepare for, survive, and rebuild after a wildfire and other disasters. We have a lot of resources on the website, kernfiresafe.org, to help you for that purpose. And as a part of our community, your feedback is welcome, and we need it. The website has a section where you can voice your concerns, ask questions, and share advice. Julia, is everybody here?
Everybody's in. Everybody that wanted to come in is here.
Well, then, without any further ado, please welcome Sally Westlake.
Thank you, David, for the introduction. Thank you, Julia, for your assistance, and Kathleen and Peggy for inviting us to join you here today. Let me go ahead and share my screen. Is it up and good?
Yep.
It is.
All right. So thank you again for inviting us to join you. And I have a lot of information to cover, so let's go ahead and get started. So under Prop 103, Californians elect the insurance commissioner. Commissioner Ricardo Lara was elected into office in 2019. The role of insurance commissioner is to protect the consumers. To protect consumers by ensuring a fair and competitive insurance market, resolving consumer complaints, and investigating and prosecuting insurance fraud. Also, to maintain insurer solvency through appropriate property and casualty rates, conducting market conduct reviews, and also to enforce the insurance laws of California. The insurance commissioner can't make new law, and any changes to the insurance laws require legislation. The fact is, insurance is a for-profit business. California is the largest insurance market in the United States and the fourth largest in the world, with annual premiums of over $340 billion. So let's take a look. Now, let me ask everyone, if you had a total loss today, do you have enough money on your insurance policies to rebuild your home? Your answer should be an astounding yes. If you don't know, that probably means you don't have enough coverage to rebuild your home after a disaster or a total loss. Now, I read various reports that indicate up to 8 out of 10 homeowners are underinsured. So what does that mean exactly? Simply put, if you have a total loss, you don't have enough money to rebuild your home. Now, did I get your attention? So unfortunately, most homeowners don't even know this until that they're underinsured until it's too late and until after they have a total loss and need to file a claim. So just imagine you've been paying your premiums every year for 20 years without questions, and you find out that you don't have enough to rebuild. This is not the situation you want to be in. So now let's take a look at what a typical homeowner's policy looks like. It's also known as an HO3. So the homeowner's policy contains two sections. Section 1 provides property coverages for A, B, C, and D, while Section 2 provides liability coverages for Section E and F. So all the homeowners policy starts with the dwelling portion of it. That's coverage A. So coverage A provides major property coverage that protects your home and attached structures if it's damaged by a covered peril. Coverage B is other structures. So this coverage provides protections to other structures on the resident premises that are not attached to the dwelling. So that includes like detached garages, tool sheds, etc. Now, coverage B is normally limited to 10% of coverage A limit. But however, you can purchase additional coverage for an additional premium. Coverage C, personal property. This coverage provides protection for the contents of your home and other personal belongings owned by you and your family members who live with you. Coverage C is normally 50% coverage of A and an established amount agreed upon by you and the insurance company. Additional amounts of insurance can also be purchased again for coverage C. And you also want to consider scheduling items separately or adding riders for items like jewelry, collectibles, and antiques, because they're a very small percentage of your personal property totals. Coverage D is loss of use. Now, this coverage will help you with additional living expenses if your home is damaged by a peril that's insured against to the extent that you cannot live in your home. So these expenses include, but are not limited to housing, meals, and warehouse storage. Coverage D is normally limited to 20% of coverage A. So in the event of a loss, it's important that you keep receipts of all additional living expenses and submit them to your insurance company for reimbursement. Coverage E is your personal liability portion. So this section of the homeowner's policy will provide coverage in the event you or a resident of your household are legally responsible for injury to others. Coverage E normally provides a defense and will pay for damages as the insurance company deems appropriate. So there are some exceptions. The liability coverage will not protect you in all situations, such as an intentional act. Now, all of the exclusions and specific language can be found in your policy. But if you're like me, who's got time to read through all of the insurance policy? But you should really look at on the first 2 pages of your declaration page, and that'll kind of break down the percentages for you. Now, coverage F is medical payments to others. Now, this coverage pays for reasonable medical expenses for persons accidentally injured on your property. For example, if a neighbor's child is injured while playing in your home, the medical payments portion of your homeowner's policy may pay for necessary medical expenses. Medical payments coverage does not apply to your injuries or injuries of those who reside in your household. So this is not a substitute for health insurance. Business activities are also excluded. So you definitely want to look at this because I know a lot of people are running their businesses from their home, especially after COVID. But all the exclusions and specific language can be found in your policy. Now, the perils generally covered and not covered by a homeowner's policy. Typically covered by a homeowner's policy if the damage is caused by fire or lightning, windstorm or hail, explosion, riot, civil commotion, aircraft, vehicle, smoke, vandalism, theft, and more. Perils generally not covered by a homeowner's policy if damage is caused by flood, earthquake, earth movement, termites, water damage, mold, and the list continues. So again, what's important to know is what's covered by your policy, but also what's excluded in your policy. So now let's take it. The next step is, are you underinsured? Do you know if you are? What you want to do is conduct an annual or biannual checkup of your coverage and its limits with your agent or broker. So let's look at some of the reasons why you could be underinsured. Rebuilding cost is not the home selling price. Insurance buyers wrongly equate the limit of insurance with home selling price. They rarely have an accurate estimation of what it would realistically cost to rebuild their home. But they can go online and see the selling price of comparable homes. Now, I've heard of a case where the selling price of the property, including the land, was determined to be at $650,000, but the actual cost to rebuild to code was actually $970,000. Think about when your home was built. Has things changed since then? It's probably safe to assume your city, county now has new building code upgrades that has to be used in building your new home. And building code upgrades can easily add 35 to 50% to that cost. Now, remember, if it's also now mandatory to put in interior sprinklers in California. Permits themselves have tripled in cost in some cities. Is building code cost and upgrades included in your policy? Do you know? Following a large disaster where large areas are affected, construction costs soar due to lack of construction crews, materials, inspectors, and etc. Currently, it's estimated that area disasters are increasing building costs in California by 30 to 35%. The necessary time needed to rebuild has gone from 14 to 18 months on average now to 24 to 36 months. There's also the cost of debris removal. This can also be a very large expense that can take up a big portion of your coverage. I've heard of a case where the fire burned so hot that it damaged the foundation, and the price tag to replace the foundation required that pilings be pounded into the slope, which added $400,000 to the rebuilding cost. So ask yourselves, will my policy completely and totally replace my home if it's destroyed? Well, this depends on whether your policy is a replacement cost value policy or an actual cash value policy. If your policy is an actual cash value policy, you don't have enough. If you have a replacement cost value policy, maybe. The policies with actual cash value coverage typically determines value by taking the cost to replace your personal belongings and reducing that amount due to depreciation from factors such as age or wear and tear. Most homeowners insurance policies now come with replacement cost coverage, the newer policies, for the structure of your home. Dwelling coverage typically helps pay for repair or rebuild your home using materials of a similar quality. It generally does not take into account depreciation of your home due to factors such as age. For example, if your kitchen is damaged in fire, replacement cost coverage may help to replace your cabinets using materials of similar quality, whether they were 15 years old or they were brand new. While you can get replacement cost coverage for most properties, you may need modified replacement cost coverage if you have an older home. This type of policy may cover the cost of rebuilding features of an older home, such as plaster walls, with alternative materials more commonly used today. Now, some types of replacement cost policies will pay your policy limits plus a certain percentage above those limits. That could be the difference in rebuilding and being able to rebuild your home with all of the additional unforeseen building costs. And that's called the extended replacement cost policy, which is an expansion of your current dwelling coverage limit. So it helps cover, again, the extra building costs that are outside of your control. Okay, while you'll want to increase coverage on your house anytime you make any upgrades or renovate to reflect its new value, sometimes the construction cost of rebuilding after a total loss can be more than what you'd expected. So the extended replacement cost policy can add up to 10, up to 50% of the dwelling policy limit. So what you need to know leaving here today is, do I have enough coverage to rebuild? If you don't know the answer to that, talk with your agent. Ask your agent, if my house burned down today, do I have enough to rebuild? If your agent can't give you the answer, well, then maybe it's time to find another agent. Okay. No one wants to pay for more for insurance, and I get it. I know I don't. Okay. But I also know that if I have a complete loss, a total loss, I have enough coverage to rebuild my home. Most importantly, you need to work with an insurance agent that understands your needs. Many agents will reduce the premium to make you happy, okay, to make their rates competitive, but this is a double-edged sword because your coverage is reduced as well. And reducing the premium saves you money in the short term. However, your limited coverage won't be enough in the event of a total loss. So it's always always worth it to pay a little more in premiums each year because you're securing your own finances in the future. So when you talk to your family, friends, and neighbors, tell them they're most likely underinsured. Get them to stop thinking about replacing the old house and start thinking about rebuilding the home with new regulations, new materials, higher labor costs, costly architectural plans, required demolition and debris removal, contractors' overhead and profit, and on it goes. So, Prop 103 also gives Insurance Commissioner Ricardo Lara the authority to regulate rate increases in property and casualty insurance. So the property rate increases are governed by law. Insurance companies have to file the rate increases with us, and it has to be approved. So the rates cannot be excessive or inadequate, but it can be higher for brush and wildfire areas. Insurers can generally choose the way they want to write and sell insurance policies. The department and Commissioner Lara cannot tell them where to write homeowners policies. Insurers, though, must maintain eligibility guidelines, and those guidelines have to be fair across the board. The rate increases the insurance companies charge have to be specific and substantially related to their loss exposure. So, insurance companies can non-renew for almost any reason that's risk related, as long as they give you 75-day notice and the reason for non-renewal. And that non-renewal reason can be very broad, okay? So what do you do if you get a non-renewal notice? Time is not on your side. You might have lost 2 weeks because you didn't open that envelope from your insurance company. You thought it was just general information, something. 2 weeks have already passed. You lost a lot of time. So again, time is not on your side. Remember, if one insurer thinks that you're high risk and non-renewed you, there's a good chance all the other insurers, okay, will think the same and consider you high risk. So what you want to do, start by calling us and file a complaint. We want to make sure that that non-renewal was issued legally and timely. Call your insurance company, okay? Ask what you can do to maintain your current policy. Sometimes it works, not often, but it has. Is there anything you can do? Clear brush around your home. Did they make a mistake? Do you have a long-term relationship with your insurance company with multiple policies? And maybe you've never even filed a claim. But the cheapest way, the most inexpensive way, and the easiest way for you to have homeowners insurance policy after getting a non-renewal notice is to get your current insurance carrier to go ahead and offer you a renewal policy. Okay, so next, you're going to work with your agent and broker about shopping for another insurance carrier. If they come up empty, you're going to widen your search. You're going to find an agent outside of your high-risk neighborhood, okay? And see if they can come up with a company that's still willing to insure your home. Because each company has different underwriting guidelines, you might be able to find a company that's still writing policies in your area. So again, if everyone in your area is getting non-renewed and you guys all go to your local insurance agent and broker, they might be limited in what they can offer. Finding an insurance carrier, an admitted carrier, they can find a policy, okay, is still willing to write a policy in your home. So you want to go outside of the area, find an agent somewhere else that could possibly find an insurance carrier that still might be writing 1, 2, or 3 more policies in your area. Because again, every insurance company has their own guidelines. So after a search with the admitted carriers, then you'll have to consider a policy with non-admitted carriers, okay, or a surplus lines policy. This just means that the insurer has chosen to transact business in California, but do so without being regulated by the department. They do this, but they still have to follow some rules set forth by the department, but they could charge more and sometimes less than the admitted carrier, okay? And we're talking about insurance carriers like Chubb's, okay, Lloyd's of London. So definitely you want to work with a broker outside of your area, but again, look at non-admitted carrier surplus lines market to find an insurance company. Then your last resort is to go with the FAIR plan. And yes, I've heard from David and Julia, and a lot of others, and we hear it from everyone in the state of California, especially Northern California, that says the FAIR plan is not fair. It's actually the opposite. It's very unfair. But I am going to go ahead and go over the FAIR plan in more detail shortly. So non-renewals can seem unfair. There's no consideration of individual tenure or claims history. No consideration of pre-fire mitigation and or structure fire hardening that you may have done. No change in your property risk. Okay, nothing's changed, but currently there is no clear statewide standards for fire-resistant structure or mitigated property that'll make an insurance company guarantee coverage. So, what can you do to keep your coverage before you ever get that non-renewal notice? So again, insurance companies can non-renew for almost any reason that's risk-related. So your claim history can cause a non-renewal. And even if you move from one insurer to another, your claims history is still going to follow you. So things under your control, things you can do to maintain your property so that when the insurer does an audit, it won't flag your property, is maintain the condition of your property. Check the roof, plumbing. Look for visible signs that need repair because you don't want to get flagged. Harden your home, clear brush away from your property. And I'm talking to the Fire Safe Council, right? So you've all done this. Clear brush away from your property, clean the gutters of any leaves, remove any flammable items stored in your property. If somehow physically you can't do it, or maybe financially you need help, talk to your Fire Safe Council. They may have grants available. Talk to your local fire department and say, hey, I'm physically unable. Maybe you're elderly. I can't remove the brush. I need help. Get assistance. There are organizations out there that can help you. And there are things that you can't control. The location of your home, whether it's near brush or forest, and unclear brush on your neighbor's property. Okay, you can't control that. Maybe you can have a conversation with your neighbor. Maybe you can refer them and give them a list of organizations that can help them maintain their property. But most importantly, your wildfire risk score. You have no control of your wildfire risk score. So now we're going to talk about the FAIR Plan. So the California FAIR Plan was established in 1968 following the riots and brush fires of the 1960s. They became the state's insurer of last resort, providing access to fire coverage for California homeowners unable to obtain it from the traditional insurance carrier. The FAIR Plan is not a state agency, nor is it a public entity. There's no public or taxpayer funding. The FAIR Plan is a syndicated fire insurance pool comprised of all the insurers licensed to conduct property casualty business in California. If you cannot obtain coverage in the traditional insurance market, the FAIR Plan may be a temporary solution. California's FAIR Plan is a last resort option, and you should continue to shop for insurance in the private market every year. Okay, so if you end up with the FAIR Plan this year, next year, do not just blanketly, go with the FAIR Plan again. You need to talk with a broker and see, hey, can I find an insurance carrier in the traditional market, admitted carrier, okay, or in the surplus lines that is willing to insure my home this year? Okay, again, the FAIR Plan is not meant for you to have continuously for long term. The FAIR Plan offers standard fire insurance policy for both the structure and the contents. This is a basic property policy that has coverage limitations. No coverage is provided for liability or coverage for other perils such as burglary. So the FAIR Plan dwelling fire policy is a named peril policy which provides coverage only for damage caused by specific causes of loss listed in the policy. The FAIR Plan coverage is limited to $3 million for all coverages combined, for the structure, the contents, additional living expenses, etc. This limit was actually at $1.5 million until Commissioner Lara had them increase the limit up to $3 million. And we know this limit may not be enough for a lot of homeowners in the wildlife urban interface. Currently, if you have a a fire policy, then you need to consider purchasing a difference in condition policy. This is the second companion policy to cover the other hazards, such as premises liability, water damage, and theft, things that aren't covered by the fire policy of the FAIR plan. So making it a comprehensive homeowners policy. So what that means is you have the FAIR plan, and then you're going to have to find a difference in condition policy around it. And that's why sometimes it's called a wraparound policy. And what you'll notice is when you get a non-renewal notice from your current homeowner carrier or homeowner's insurance carrier, it says, we're going to non-renew. You might want to consider contacting the FAIR plan. Here's our number. And at the bottom, but we'd be happy to sell you the difference in conditions policy, because there isn't the wildfire risk related to the difference in conditions policy. Your insurance carrier XYZ doesn't want your fire portion of the policy, but they'll be happy to sell you the difference in condition policy. But what that means to the homeowner is now you're paying double or triple sometimes the price, because you have to buy the fire from the FAIR plan and then a second policy, a difference in condition policy on top of it. So the good news is that Commissioner Lara requested, then ordered the FAIR plan to offer full comprehensive policies. That was back in September. That was after they took us to court. The FAIR plan says, no, we can't do this. Okay, took it to court. The judge ruled in our favor and said, okay, no, the FAIR plan needs to make and offer full comprehensive policies. Most recently, the FAIR plan is now appealing the judge's ruling. So we are still not, the FAIR plan is still not offering full comprehensive policies, but hopefully in the near future, we can make this happen. But this order, if it does happen, will give approximately 200,000 Californians who currently rely on the FAIR plan to protect their homes a more comprehensive option besides the bare bone coverage that the FAIR plan currently offers today. Let's look at what CDI, the Department of Insurance, and Commissioner Lara has been able to accomplish. It's increased consumer protections for Californians. He's made it where after a wildfire declared disaster by Governor Newsom is established, that he orders the insurance companies to offer expedited claims processing for those wildfire survivors. He has them now, the insurance companies, offering the additional living expenses, ALE expenses, upfront to 45 days without giving them the receipts. So you can get money upfront, and that's after a total loss. Also on the property contents, the insurance companies are to pay up to 25% without getting the list of the itemized inventory. Okay, so more protections for Californians. He orders the mandatory one-year moratorium on insurance companies non-renewing or canceling residential property insurance policies after a declared disaster. That's protecting 2.4 million policyholders affected by the record 2020 wildfire season alone. So after a declared disaster, it's not only the wildfire survivors that are protected from cancellation or non-renewal, but the zip codes surrounding the disaster area will now have this one-year protection of non-renewal. He's also helped homeowners to recover from fires and find homeowners insurance. He's assisted homeowners in filing claims and maximizing their insurance benefits following a disaster. And he signed into law in 2020 by Governor Gavin Newsom that will cut the red tape of wildfire survivors by removing company-specific forms, requirements for home inventories, requiring, again, advanced payment of living expenses, giving grace periods for payment of premiums for 60 days. Because after a disaster like this in the wildfire, people are lost. They can't find their policies. They forget when the payment dates are. So there's actually a 60-day grace period of even making your homeowner or any insurance payment premiums. And again, additional living expenses to be paid when a home is uninhabitable due to an evacuation order or lack of water or even lack of power caused by a fire. So Commissioner Lara will take the following actions as regulator of the nation's largest insurance market. So he's working to developing home hardening standards that are consistent, based in fire science, and applied to all insurance companies, giving transparency to consumers about their wildfire risk score and what they can do to reduce it. So insurance companies use these wildfire risk scores to determine which homes they'll write and how much premiums they're going to charge. Also creating insurance incentives, recognizing home hardening, mitigation of properties, and community mitigation actions altogether, and requiring that insurance companies seek adequate and justifiable rates to protect the solvency of the market. Statewide standards for fire-resistant structure or mitigated property. How does this sound? If you harden your home to a set standard, shouldn't you be guaranteed insurance? Shouldn't you be insurable? Shouldn't there be a benefit to hardening your home? So Commissioner Lara and CDI is trying to establish these standards that'll require insurance companies to consider home hardening as part of their rating and underwriting of homeowners insurance. So unfortunately, insurance fraud still exists. And after a disaster, there's scammers out there that have come out to take advantage of the wildfire survivors. So this can be unlicensed public adjusters, contractors, and so many more. So we'll dispatch a team from our 400-member enforcement branch to any disaster site to prevent scammers from lurking around and trying to do business illegally and taking advantage of the survivors. So if you suspect fraud, you are a victim of fraud, please report it, call us, we can help. And at the Department of Insurance, we have a wealth of resources to assist consumers. We offer informational guides on all lines of insurance. It's available on our website, or you can have a hard copy mailed to you if you'd like. So one I want to mention is the home inventory guide. So it's a workbook that you need to fill out. Room by room, you'll inventory and list every item in your home. Yes, it's very tedious, time consuming, but it can save you thousands of dollars and hours of headache if you do this now before you have a total loss, because your insurer will require you to give them a list of everything you lost and you want to claim. The more itemized your list, your inventory is, the more you can claim and get paid from your insurer. Also, we have the top 10 tips for finding homeowners insurance. This guide will help you through the process of finding homeowners insurance, like I mentioned earlier, especially if you've been non-renewed. So on our website, we also offer the homeowners insurance finder tool. If you've been non-renewed, go ahead and take a look at this. Enter your zip code, and it'll list the insurance companies or agents and brokers that's still writing policies in your area. And we also have the annual consumer complaint study. So do you know how your insurance company ranks? Every year we report justifiable complaints filed against your insurance company. Don't you think it's important to know how your insurance company ranks before you actually have to file a claim and then might have to file report the insurance company to us? So those are just some of the resources available for consumers at the Department of Insurance. So please visit our website at insurance.ca.gov. Again, we have a lot of resources available to you. So if you have any questions about your current insurance policy, new policy, or you've been denied coverage, claim, or canceled, want to report fraud, you can call our consumer hotline at 1-800-927-4357 or visit our website at insurance.ca.gov. Our insurance commissioner will tout our consumer hotline as one of the best hotlines available through any state agency in California, because our hotlines are answered between the hours of 8 to 5, Monday through Friday, within minutes, within 2 minutes. You do not have this long extended 20, 30 hour long hold. Okay, you just press a couple of buttons indicating whether you have questions about health insurance or other lines of insurance. Okay, if you have a specific different language need, press a couple of buttons and then you can talk to, okay, an insurance compliance officer that can assist you with any issues that you might have. So again, call us or visit us on our website. So thank you again so much for your time today. And I'll turn it back over to Julie and David for any questions from the audience.
Great. Thank you, Sally. And please accept my apologies for the feedback.
No worries. I didn't get too much feedback on my side. I don't know if you heard my little dog yelping in the background as well.
Okay, as long as that was your dog, we're good.
Yes. Sorry
Yeah,
about that.
and thank you so much for being with us tonight. That was a lot to digest.
Yes.
And we have questions. Julia, we have questions, right?
We do have some questions. So, Sally, you may have covered this, but maybe not in these terms. So can you address the 80% rule as it applies to the purchase of homeowners insurance to protect the dwelling?
Okay. So there is a rule that most insurance companies use, and it's called the 80% rule. So they are looking at the replacement value of your home. They'll say, based on all their underwriting guidelines and their numbers, they punch in your address and your roofing type, okay, what your home is currently made of. And then they look at how much would it cost to rebuild your home in today's dollars. And let's say they use the number 500,000. That is your replacement value. That's what they consider it would cost to rebuild your home. But if you choose, okay, to buy a coverage limit underneath their replacement value, okay, they encourage at least minimum of 80%, which would be the $400,000 mark. But if you choose to purchase your policy on the dwelling portion, remember I covered part A, the dwelling portion underneath that 80% mark of the 400,000. And let's say you purchase, you say, no, I can't afford it. I don't think it's going to cost $500,000 to rebuild my home. I think it's only going to cost $395,000. If you choose that option, and you have every right to purchase whatever policy limit you choose. Okay. So let's say I'm going to purchase my policy limit for $395,000 on the dwelling portion of it. Guess what? If it comes to a total loss and you need to file a claim, the insurance company is going to enforce that 80% rule and say, you do not have enough coverage, so they may not pay up to your $395,000. Okay. They're going to use another calculation and use that method and say, okay, we'll only pay you 80% under what you purchased. And so you may only end up with getting $300,000, not even the $395,000. Okay. So you definitely want to, we encourage talking to a contractor in your area and get a realistic rebuilding cost per square foot. It might be $250,000 today, but if there's a wildfire declared disaster where, like some of the Paradise, where the entire community is gone, it's no longer $250,000. We're looking at $450,000, $550,000 to rebuild. In Malibu, it went up to over $1,000 a square foot. Okay, wow. Just because there is no lumber, there's no construction crew. There is no living in Paradise. Everyone's had to move, so those costs skyrocket, and that's why you need to have maybe an extended replacement value policy that puts that extra cushion above your policy limit, okay, so that these unforeseen costs can be taken into account.
Okay. So then I am assuming from what you said, then the answer to the next question is yes, and that's how do capital improvements affect the 80% rule? And I'm assuming that if you do some improvements to your home, you should call your agent immediately.
Yes, definitely. Any improvements made to your home, it should show, okay, on your policy so that you can have it replaced to that value. So if you do a whole new kitchen remodel and spend $30,000 doing it, the insurance, you don't ever report it to the insurance company. If you have a total loss, they're not giving you rebuilding a new kitchen to those standards that you had done. They only have you on record as the kitchen from the 1960s when the home was built. Okay. Now we understand, yes, letting them know about your home improvements, increasing your policy limit is going to cost more in the short term, right? Yes, it's going to cost more, but it doesn't have to be a huge expense. But if you don't have that, if you don't consider that, you may not be able to rebuild your home at all. Okay.
Yeah, that makes sense. So the next question is homeowners insurance tax deductible?
I can't give tax advice on that. That's something that you're going to have to talk to your insurance, talk to your tax advisor about. But I do my own taxes, and I have not found it to be able to deduct my homeowner's insurance.
Okay. Okay, so now what kind of separate insurance should we buy for natural disasters? And why don't insurance companies offer these coverages under their homeowners policy?
Okay, so two kinds that we're talking about here: flood insurance and earthquake insurance. So flood insurance you get from the federal government, from FEMA. Okay, it's basically regulated. And then you have earthquake insurance, and it has to do with insurance companies in the admitted carrier market that says they don't want the risk. They cannot afford to affording earthquake insurance in a given area, especially like in Southern California, where earthquakes happen all the time. They don't want that risk. And so there is the California Earthquake Authority. Okay. So all these insurance companies that are admitted carriers are members of the California Earthquake Authority. And so every 2 years, your homeowners insurance carrier have to offer you earthquake insurance. Okay. And it's up to you to say, no, yes, I want it. And so all the large insurance companies like State Farm, Farmers, okay, Geico, Mercury, they're all members of the California Earthquake Authority. So they will go ahead and make the offer to you. You can go ahead and say, yes, I want earthquake insurance. You can go over the limits. Now, and they do the billing. So it's built into top of your homeowner's policy so that you make one payment, basically. It's on top of your homeowner's policy, would be the California Earthquake Authority, okay, policy on top of it. Now, a lot of people say, well, okay, I can't afford earthquake insurance. You can make it affordable. By again, you can lower the premium by upping the deductible. Okay, so especially if you have equity in your home, if your home is all paid for, are you willing to take that risk of the big one coming and totally demolishing your home and you have nothing left? You have land left. Now, someone like me who's still working, I have a mortgage to pay, right? But I have some equity. But after a big earthquake, without earthquake insurance, I could lose my entire equity, still owe the bank for a home I no longer have standing. Okay. Am I going to wait for the government to help me? Because FEMA, the last time I heard it was up to $35,000 maximum. Okay. Is that going to rebuild my home after an earthquake? No. So I can make earthquake insurance affordable. They made changes to it. You can play with the numbers, talk to your agent about taking on earthquake insurance, making it affordable. Again, I'm going to up the deductible. So now some people say, well, I can't ever possibly pay the deductible. Let's say I have a $50,000 deductible. I don't have $50,000 in savings to make the deductible. Well, before it used to be that I had to come up with the $50,000 first before the earthquake insurance kicked in. It's still my deductible, but after a total loss, okay, earthquake insurance, California earthquake will still pay to rebuild. Yes, I have to come up with $50,000, and that's where I will get a loan from the SBA after a disaster. So I can get a low cost loan on that $50,000 to make the deductible. So yes, you can make earthquake insurance affordable. They have to offer it to you again with the law every 2 years. And again, flood insurance, if you're in the flood zone, which is determined by FEMA, and it's offered again through a FEMA program, they look at the floodplains. But again, if you're in a flood zone, your homeowners, especially if you have a lender, they will require you to have flood insurance. Okay. If you need more information about those two types of insurance, it is available on our website. But again, like flood insurance is not under our jurisdiction. There are a couple of companies that offer flood insurance on their own outside of FEMA in California, and also with earthquake insurance. There are a couple of insurance carriers in California that sell homeowners insurance that says, okay, we don't mind the risk. We'll sell earthquake insurance. Okay. So go ahead and give us a call with any more questions about it.
Okay, that makes sense. So it's really worth it, like if you up your deductible to get insurance, because if you need it, I mean, I remember the 1994 quake, and thank goodness we were covered, but it's really important. So hopefully everybody will do that. And you said that most insurance companies added on. I'm with a big name insurance company, and I pay separately for my California earthquake insurance.
Okay, so there is a small chance that your insurance carrier may not be a member of the earthquake authority, and so that's why it's not built in. It's supposed to be built in on top of. I mean, I don't know if your policy dates are different, and that's why.
Oh, I don't know, maybe, but I mean, I can pay it from their website. It just has to be paid separately.
Okay, traditionally it's built on top of your homeowner's policy.
Okay. And well, there's two more questions I've got here, Sally, and they're both related to the FAIR plan. And the first one is they want to know, how can we as an individual challenge a fire score if we think that it's wrong or outdated?
Okay. Bad news. As an individual, you cannot challenge your fire risk score. Okay. So we use the term wildfire risk score to be generic term. Okay. Most insurance companies use this company called Fireline. And they are designed to predict the propensity of a structure in that location to burn in a wildfire, not when or where the fire will happen. The main factors considered in a score are the vegetation, slope, okay, whether it's steeper is worse, and access to your home. Is it one lane, dead end roads can be a problem for emergency vehicles, okay? So homeowners and communities can't do much to lower their fire line scores because it's looking at exposure to fire hazard in generally a quarter mile around that property. So if you have a tightly packed neighborhood and one home has maintained a defensible space and the other has not, it may not reduce the risk all that much. Community efforts, though, unless on a very large scale, also do not impact those scores. And that's exactly what Commissioner Lara says is unfair. Okay. This company uses a satellite image. Yeah. It says, okay, look at the slope, look at the vegetation and access, and here's your fire line score. Insurance companies, a lot of them use this fire line score to say, in their underwriting requirements, to say, okay, we are not writing in this zip code area because of this fire line score. Some insurance companies have their own way to use come up with their own fire risk score. Most companies use this company and it's called Fireline score. Okay. Again, you cannot challenge it. Department of Insurance and Commissioner Lara is challenging this and saying, we need to know what the fire line risk score is. We want the insurance companies to tell us how they're using this score in their underwriting criteria, make it transparent. And then also having the opportunity for us as an individual homeowner to lower our fire line scores, which we cannot do right now. So this is what Commissioner Lara is currently working on. Okay. Then there's another company that also gives out the Insurance Services Office number, ISO. You may have heard that. So there's the fire line score and then the Insurance Services Office, ISO score, which rates communities nationwide based on their ability to respond to structure fires, not wildfires, but the communities can improve this score. Okay, it looks at water supply, emergency communication systems, the local fire department staffing, equipment and training, and other factors. Now, it gives each community a public protection classification of 1 being the best to 10 being the worst. And so many insurers incorporate this score into their decision-making as well, but it's not the same as the fire line score. So this ISO number, okay, and the public protection classification can be given to you. Your fire department knows it. And they work on this every year, okay, to improve this score. What else? Oh, your insurance agent. If you want to know what your fire line risk score is, your insurance agent may be able to tell you. Okay, so ask your agent.
That's a good suggestion.
Excuse me?
That's a good suggestion.
Yes. Next question.
Okay, and this is the final question. So everybody, if anyone here has a question still, please type it in the chat so that we can address it with Sally before we end here. So this is again about the California Fair Plan, and it's about their payment option. And apparently there is no payment option, and it's like you have to pay 3 payments. And this person was thinking that maybe if they could do a 12-month payment plan, it would be easier for people to opt in. And I wondered if there's anything in the works for that, or if that's a suggestion we could put into your office.
Yes, so that's a great question. And again, the Commissioner Laura looked at how unfair, okay, the fair plan can be. And so he has made changes to the payment structure and the payment options. So currently now because of Commissioner Laura, they are accepting credit card payments, and that is a nominal fee. But we realize when everyone's had to go to the fair plan, we've had seniors that are on fixed incomes where their homeowners policies used to be at under $2,000 a year. And then they had to go to the fair plan, and it tripled, doubled, more than that at $10,000. And yes, they were saying, okay, you have to make this payment in one lump sum payment. Okay, that's not fair. That's not affordable. So yes, Commissioner Laura is currently working to make more payment options available through the fair plan. But again, the fair plan not being a state agency, Commissioner Laura can order them to do certain things, but they are fighting us. And so it is not a near-term fix, but yes, Commissioner Laura is aware of the limited payment options.
Okay,
so thank you for that question.
That's great. Okay, we have one more question that just came in. How is the new 0 to 5 foot ember resistance law going to affect insurance?
Right now, that's going to be used. Great question, first of all, but that's going to be used with the government, with a new team partnership that the Governor Newsom has signed on to a couple months ago with the Department of Insurance, Cal OES, Cal Fire, to come up with set standards for communities and statewide. So if we can agree on come up with a set standard for the entire state and then for the communities, so that once the community has done this, the insurance companies have to accept that they've complied, take that into consideration, and then offer them, basically, they have to be insurable or given a discount for following those set standards. So that's what's currently in the works, is coming up with the set standards. Okay. I've heard of a few insurance companies that will take into account the home hardening that you've done, the mitigation that you've done, your mitigation efforts. So again, every insurance company is different. Okay. And you need to have a talk with your insurance agent and your broker and say, hey, look, I've done this. Are you aware? Here's the improvements, but also here's the home hardening things that I've done. Is there any discount? Okay. Again, have that talk with your insurance carrier.
Okay. Well, thank you. There are no more questions, David.
Well, and we're running out of time too. So if you come up with a question, please put it on the website. We'll try to get it answered for you within a week or so. We will post any answers, any questions, any answers that we receive on that. Sally, thank you so much for your time. Oh, very complicated. Insurance is difficult to comprehend. at the best of times, but you've cleared up a lot of some of the misconceptions for us, and I thank you for that. Ladies and gentlemen, there will be a webinar next month, so watch the website or the Facebook page and Instagram for the date and our topic of discussion. Until then, please keep your space defensible and pack your go bag because, well, you live in California right now. I'm David Stenstrom, and along with Julia Naiman, please, we wish you a very pleasant good evening.
Thank you,
very
David.
much.
Julia.
Bye-bye.
Thank you,
You're
everyone.
welcome.